Cryptocurrency investing, when approached with a long-term perspective, can be a powerful way to build wealth while supporting an emerging technology that has the potential to reshape modern society. However, it requires a disciplined strategy, sensible allocation of resources, and a deep understanding of the market's potential and risks. This guide focuses on building a sustainable and well-informed cryptocurrency investment strategy for long-term success, emphasizing moderate spending of disposable income over the years. The foundation of long-term crypto investing starts with a clear belief in the transformative potential of blockchain technology and digital assets. Cryptocurrencies like Bitcoin have already disrupted traditional finance by offering a decentralized peer-to-peer system of value transfer. Ethereum has expanded the use case of blockchain by enabling smart contracts and decentralized applications, dApps. Other projects such as Cardano, Polkadot, and Solana are working to improve scalability, interoperability, and security. By understanding the utility and potential of these technologies, investors can develop confidence in their long-term viability. Before diving into crypto investing, it's essential to assess your financial situation. Begin by ensuring that you have an emergency fund covering 3 to 6 months of living expenses. This buffer protects you from financial instability and allows you to invest in crypto without undue stress. Next, determine how much of your disposable income you can allocate to crypto investments. A good rule of thumb is to invest no more than 5% to 10% of your disposable income, ensuring that you don't jeopardize your financial well-being. Once you've set your budget, focus on building a diversified crypto portfolio. Diversification reduces risk by spreading your investment across multiple assets with different use cases and risk profiles. Bitcoin, as the first cryptocurrency and a store of value, often serves as the anchor of a long-term portfolio. It's widely regarded as digital gold due to its fixed supply and decentralized nature. Ethereum, known for its robust ecosystem of decentralized applications and smart contracts, is another cornerstone investment. Beyond Bitcoin and Ethereum, consider allocating smaller portions of your portfolio to promising altcoins. Cardano, Polkadot, and Avalanche are notable for their focus on scalability and interoperability. Binance Coin and Solana are popular choices for their vibrant ecosystems and utility in decentralized finance, DeFi, and non-fungible tokens, NFTs. When selecting altcoins, prioritize projects with strong fundamentals, active development teams, and growing communities. Avoid speculative tokens that lack clear use cases or long-term potential. Dollar cost averaging, DCA, is an effective strategy for long-term crypto investing. Instead of trying to time the market, which is notoriously volatile and unpredictable, DCA involves investing a fixed amount of money at regular intervals, such as weekly or monthly. This approach smooths out the impact of market fluctuations and allows you to accumulate assets over time. For example, you might invest $100 in Bitcoin every month, regardless of its price. Over the years, this consistent approach can yield substantial gains as the market grows. Security is paramount in crypto investing. Start by choosing a reputable exchange for buying cryptocurrencies. Coinbase, Binance, Kraken, and Gemini are popular options known for their security measures and user-friendly interfaces. After purchasing crypto, transfer it to a secure wallet. Hardware wallets like Ledger and Trezor are considered the gold standard for long-term storage, as they keep your private keys offline and safe from hacking attempts. Software wallets like MetaMask and Trust Wallet are suitable for smaller holdings or interacting with decentralized applications. Always enable two-factor authentication, 2FA, on your accounts and avoid sharing sensitive information online. Long-term crypto investing requires a focus on education and staying informed. The crypto landscape evolves rapidly, with new technologies, regulations, and market trends emerging regularly. Follow reputable news sources like CoinDesk, The Block, and Decrypt to stay updated. Participate in online communities such as Reddit's r/cryptocurrency or Twitter to engage with other investors and gain diverse perspectives. However, be cautious about unverified information and hype-driven content. As your portfolio grows, Periodically review and rebalance it to ensure it aligns with your goals and risk tolerance. For example, if an altcoin's value has significantly increased and now represents a large portion of your portfolio, consider selling a portion to lock in profits and redistribute the funds to other assets. Rebalancing helps maintain diversification and protects against overexposure to any single asset. Real estate offers several tax advantages that can enhance your returns. You can deduct expenses like mortgage interest, property taxes, and repairs. Depreciation allows you to reduce your taxable income over time. Consult with a tax professional to ensure you're taking full advantage of these benefits. For those who prefer a hands-off approach, REITs and crowdfunding platforms like Fundrise and Realty Mogul provide opportunities to invest in real estate with minimal effort. These platforms allow you to invest in diversified real estate portfolios with relatively small amounts of capital, though it's important to read the fine print and understand the fees involved. Cryptocurrencies are another rapidly growing asset class. These digital assets operate on blockchain technology, a decentralized ledger system that ensures transparency and security. Bitcoin, the first cryptocurrency, introduced the concept of peer-to-peer digital payments without the need for a centralized authority like a bank. Ethereum expanded on this by enabling programmable smart contracts, which are self-executing agreements coded directly onto the blockchain. Beyond Bitcoin and Ethereum, there are thousands of other cryptocurrencies, each with unique use cases and technological foundations. These include utility tokens like Binance Coin, privacy-focused coins like Monero, and decentralized finance tokens like Uniswap. Understanding the underlying technology and purpose of each cryptocurrency is crucial before investing. To invest in cryptocurrencies, you'll need to use an exchange. Popular exchanges include Coinbase, Binance, Kraken, and Gemini. Coinbase is beginner-friendly with a clean interface and straightforward processes, making it an excellent choice for new investors. Binance caters to more advanced traders with a wide selection of coins, low fees, and additional features like futures trading and staking. Kraken is known for its robust security measures and comprehensive support for fiat currencies, while Gemini emphasizes regulatory compliance and security, appealing to institutional investors. To get started, create an account on your chosen exchange and complete the Know Your Customer process by verifying your identity. Once verified, deposit funds using a bank transfer, credit card, or other supported payment methods. Be mindful of deposit and withdrawal fees, which vary by exchange. Once you've purchased cryptocurrencies, it's essential to store them securely. Exchanges provide custodial wallets by default, but these are not the safest option for long-term storage. Consider using a hardware wallet like Ledger or Trezor, which stores your private keys offline, protecting your assets from hacking attempts. Software wallets like MetaMask and Trust Wallet are also popular, particularly for interacting with decentralized applications and DeFi platforms. Understanding how blockchain technology works is critical for cryptocurrency investing. A blockchain is a distributed ledger that records all transactions across a network of computers. Each transaction is grouped into a block, which is then added to a chain of previous blocks. This structure ensures that data is immutable and transparent. Mining and staking are two common methods for validating transactions and maintaining the blockchain. Mining involves solving complex mathematical puzzles to add new blocks to the chain, as seen in Bitcoin. Staking, used in proof-of-stake systems like Ethereum 2.0 and Cardano, involves locking up a certain amount of cryptocurrency to participate in the validation process and earn rewards. Research is a critical component of cryptocurrency investing. Start by evaluating the white paper of a project, which outlines its goals, technology, and use cases. Assess the team's experience and track record, as well as the project's partnerships and community support. Platforms like CoinMarketCap and CoinGecko provide comprehensive data on cryptocurrency prices, market capitalization, and trading volume. On-chain analysis tools like Glassnode and CryptoQuant offer insights into network activity. helping you identify trends and potential opportunities. Diversification is as important in cryptocurrency investing as it is in traditional markets. Avoid putting all your funds into a single coin. Instead, build a balanced portfolio that includes a mix of large-cap cryptocurrencies like Bitcoin and Ethereum, mid-cap coins with growth potential, and small-cap projects for higher risk-reward opportunities. No matter what you're investing in, risk management is crucial. Never invest more than you can afford to lose, and always have an emergency fund in place before venturing into high-risk investments. Setting stop-loss orders can help protect your investments by automatically selling an asset when its price falls below a certain level. Rebalancing your portfolio periodically ensures that your investments align with your goals and risk tolerance,